Good morning, everyone. Welcome to this global update for stock markets for the 4th of October. And volatility is still absolutely running things at the moment. We saw an extraordinary session. In fact, we saw an extraordinary week. The American market was down heavily and then recovered very strongly to finish the week. But even Friday was extraordinarily volatile. After the jobs report came out, the S&P index dropped for 40 points, which is sort of roughly 400 points on the Dow, and then an hour later, it had completely reversed and was up by 20. So that was the equivalent of about a 600 point swing on the Dow Jones, and I just can't help but think that that's just not decisions that human beings would make. I just think this is a lot of this market action is being driven by computer programs, and it's making it very, very tricky to trade during this period of time. So let's get on and have a look at the action from last week. American stocks ended up 20 points higher on the week, but that was really all about that finish on Friday night. So from my perspective, the medium term is down. Now, I've been saying for a long time that I don't believe that stocks need to fall based on valuations and fundamentals, but that doesn't mean that they can't. So there is some evidence of a changing character in the S&P 500. It's doing things now that it hasn't done over the last 3 or 4 years. So I think the medium term is down, but the short term is up. But look, it's really high volatility. It's really hard to read the patterns at the moment. Now, last week I wrote expect more whipsawing action for a few weeks, and we certainly got that during the week just gone. It was pretty extreme. And as I mentioned, some pretty amazing computer-driven action on Friday night. Now, the US earnings season will start very soon, and the key sectors that we're interested in, I'm expecting, based on the data that I've seen so far, a pretty good earnings season, and a lot of these stocks now are trading at really, really cheap valuations. So hopefully that upcoming reporting season may help right the ship a little bit in terms of getting a bit of common sense back into the market. But at the moment, traders are basing the pricing on worst case scenario. So whatever negative news can be baked into a share price, that's what's happening at the moment. And it's going to take some good earnings evidence to turn that sentiment around. Now, also too, I want to have a quick look at the Shanghai Composite Index, because it's looking pretty wobbly. And if that were to break to the downside and have another strong leg down, then that would obviously continue this volatility in global markets. So let's go and have a look at some of these charts. We'll start with the S&P 500 index, and let me just pan back to make the point about this change in character. So you can see all through here the moving average strongly rising, the index above it almost the entire time. We've now got the moving average has rolled over. So the moving average has not rolled over since 2011. So there was the last time that it rolled over, in August, September of 2011. But the market had basically pretty much recovered by, let's say, mid to late November. Now, 2011 was a pretty scary time. The people were talking about the euro falling apart and all sorts of nasty things, far worse than I would have thought the circumstances were at the moment. But all of that nervousness had played out by mid to late November. Now, this time, we've got a larger excursion below the moving average, and we're considerably below it. We haven't managed to rally back up to it. And as you can see, the moving average has rolled over. So there's no question in my mind that the character of the market has changed. Now, does that play out as a consolidation zone in this area here between, let's say, 1860 and 2000? Or do we get a bigger retracement of the whole run from 2011 from the bottom, which brings into play this first Fibonacci level. There's also some supports here, and that's around 1728, and that's a fair way down from where we are now. So obviously we don't know the answer to that question yet. It'll be resolved by a move either above 2000 or below 1867. So that's really what we're waiting to see. Now within that band, we saw some amazing volatility, and you can see from the index here on Friday night that, you know, at one stage it was trading down at 1894. So it was just all over the place. Now I've just put a retracement structure on this run from the peak here on the 17th September to the low a couple of days ago. And what I'm trying to assess here is how strong is the rebound in the S&P. Now, so far it's gone through 2 Fibonacci levels. If it gets through the third one, which is about 1964, then you'd have to conclude that there's a lot more strength in this market yet. So we might get an indication of that in the early part of next week if this rally can continue through to the upside. So for me, medium term downside, short term the momentum is definitely up. If we look at this on a monthly chart, you can see that August and September were fairly similar to August and September in 2011, and then we got a strong rebound in October. So a lot of things will be resolved in the next 2 to 3 weeks in terms of where the market's going. Now, just looking at the Shanghai index, just to explain what I mean here, you can see we've had a massive leg down from around 5,200 points, got down to 3,400. We then had a fairly volatile consolidation, then it fell again to 2,900, and we've had another consolidation, but it just looks to me like it's rolling over. You can just see here how we've got very short term, the action has quietened down a lot, but you can see that we've definitely got a short term downward bias. So if that index gets below 2950, I think it could possibly let go again and make another big leg down, and that'd drag everyone down with it. But that's all short term. We'll just have to wait and see how it all plays out. Now, turning to the Australian market. So this is the ASX 200. We've been looking at this quite a lot over the last few months. So we've got a very clear downward channel. There's no question about that. And then we had this wedge pattern set up within that downward channel. We got a breakdown. In fact, a very definite breakdown. A huge range day, closed right on its lows. That was last Tuesday. But then the market immediately rebounded, went back up to the top of the wedge. But you'll notice it's unable to break this downward trend. So the question is this a false break of support of this wedge, or and therefore are we going to continue in this pattern, or even perhaps break upwards up to here? Or is this false break it's not a false break at all? In fact, it's the first warning sign that we're heading lower. Can't answer that at this stage. We've just got to monitor it, but it's getting very tight. The key levels here are 49.30 and around 51.50. So it's only a 200-point range, and we've had plenty of days on the Australian market where the index has fluctuated more than 100 points. So 200 points is really not very much at all. So the Aussie dollar remains weak despite the US dollar index falling in the latter half of last week. So the US dollar fell against the basket of currencies, the euro and the yen, which should have really given the Australian dollar some strength, but it didn't. It's still in the low 70-cent area, and I think that's just indicative of where we're at. So I still think the low to mid 60-cent area is the most likely outcome for the Aussie dollar. The ASX 200 index was up by 10 net on the week, all that volatility, and in the end we didn't go anywhere. So we're still stuck within this wedge in a downtrend. Turning now to commodities, gold was down $8 for the week. It's still on a longer term sell signal to my mind. There's a lot of gold bugs who are getting excited about the fact that gold might be about to break out, but look, it still hasn't. We had a short-term rising channel last week that I pointed to, but that channel has failed. So, which is no surprise to me at all, because the longer term is still down, and stocks are still not confirming a change of trend. But this could be a base. I will concede that. So let's have a look at the chart patterns around gold. So we'll look first of all at gold on a daily basis. So if we'll pan back with the weekly chart when I look at that in a minute. So short-term uptrend, but basically we've been stuck within this range here from 1,080 to about 1170. So roughly $100 range, pardon me, on gold. Now you can see in the short term we formed a higher low and we had a short-term uptrend, but we failed to form a higher high, which is really what has to happen. So we need to get above 1170 to then complete a pattern of a higher low and a higher high, and that would indicate a change in direction. So I'm not in the slightest bit interested in jumping on board the gold bandwagon until we got above 1170, and even then it's not really enough, as you'll see from the weekly chart. But certainly a bit of a spike up in gold on Friday night with the nervousness. Now just looking at this is the weekly chart, so a much bigger picture. So we formed a big wedge which had a base around 1190, and that formed from the middle of 2013 through to the middle of 2015. So that's 2 years that wedge took to form. Declining highs, we broke through the bottom of it, and we met up with this long-term rising trend line that picks up the lows in 2006, 2008, and so far that line is holding support. But you can see we're rapidly narrowing to a point where something's got to give. Gold either has to break down, which would target around $1,000 in the first instance, or it needs to get its act together and break upwards. So on the shorter term chart, I'm looking for 1170, but even then you can see if we extend this trend line through here, you've really got to be up above 1300 to really feel confident. You know, that would be above the top of that wedge line. It would probably also be above the moving average. So you've really got to get up there to feel that gold is going back into a renewed uptrend. Just looking at the gold stock indices, this is the HUI index. You can see we're down a long way. The HUI index back in 2011 traded at 627. It's now barely hanging on to 110 at the moment. So that's 85% loss in value. Now this may well be a base that's forming, but at the moment the moving average is still strongly down and the price is well below the moving average. So that's an indication of weakness. And I'd really need to see the HUI index up above around 135 before I could get excited, because I think this could be a consolidation that goes on for some time. So I continue to strongly recommend that you don't go jumping on the gold bandwagon at this stage. Turning to other commodities, copper was stable around $2.32. Crude oil was steady at 45, so no real movement there. But I still think that if crude is going to drop out of this move out of this consolidation zone short term, then it's more likely to go down than up, in my view, and certainly the fundamentals would support that. So just looking at the spot copper chart, you can see there hasn't been a lot of movement there for the last 2 months. So overall, to wrap it up, the overall strategic approach, you've just got to take a lot of care with this market at the moment. The volatility is just so extreme. Hopefully earnings season in America will help resolve the tussle between the bulls and the bears, and we start to get a bit of a trend in the market rather than this really volatile washing machine that we've got at the moment that really makes life pretty difficult. If you're a trader, if you're an investor, it's a lot easier. But if you're a trader, it's pretty hard work at the moment. I still think that a W kind of bottom, maybe with the second part of the W, whether that's a bit higher or a bit lower or the same level, is the most likely outcome. I see really strong value in several sectors in America. I still remain extremely cautious on Australia, but I think you should wait for confirmation, definitely. Now, just a question, if I may. These weekly videos are for the benefit of members and also for non-members. It's a general overview. Now, I am mindful of the length of these videos. I've been working on the assumption that most people would want to see short, sharp videos. But I have had a few comments and questions from some people that have said, look, if you want to provide more detail, then I'm happy to watch something that's 25 minutes or more. I really need some feedback because what I want to do is provide a service that people want. So if you could provide me with some feedback as to the length of the video, the detail of the video, any feedback at all is helpful so that I can provide a better service for you. So there's my website address, there's my email address. If you don't respond to me, I don't know. So I'd really appreciate as much feedback as I can get on the length and style of these weekly reports. So that's it for this week. Cheers.